just for the sake of your notes and whatnot, if we weren't seeing such a several hundred handle opening gap, this area right here on the 15-second chart, I would have already used that for institutional ortho entry drill. So I would already have a initial position on, but because it's such a large gap, I'm giving a chance for the market to try to make an attempt to run out its initial high. So far, that's what I was explaining earlier. If we didn't have that several hundred handle gap up, if it was say like a 60 handle, 50 handle, certainly 40 handles, if it would have gapped just that much from yesterday's settlement price, this right here, that would have been an entry for me. But because it's like this, we have that really, really large opening range gap, always give the opportunity for the market to do like this. Okay, I'm winding down a little bit and then start running and take out the high, because it could continuously keep going higher. Okay, so there's the initial highs being taken. All right, so you can't use this candlestick in 31, no gap, 32, no gap, 33, no gap, no gap, no gap, no, yes. So this is first presented fair value gap. And we'll extend that to the right. And for now, we'll just keep it gray. So we have taken out the initial high of the day after a very large range gap opening. We're not rushing, and we're just going to simply relax and let price give us a scenario that we can trust. If you don't mind, I'm just going to work with this single chart because it's a little too much going on. And again, we're favoring the likelihood that we could draw back down into mid gap, which is a good distance down here. Okay, so it's a lot of range to get down there. Doesn't mean it's going to do it today's session. Doesn't mean it's going to do it in the morning session. There you go. See where the bodies are here? Midpoint of this first gap, and then we're up into this inefficiency right here. Okay, now watch the midpoint of this here. I don't have my little settings on. Terrible, 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 Phil. Want to see price stay in the lower half down here and aggressively run below this low here. So initial fair value gap, model 2022 first, then we traded down, and I was trying to time at the low because I wanted to show the lowest entry in this first fair value gap. But this is actually even better because it was outside of that. So you can see how it's already very forgiving. The draw is mid gap in the first the first 30 minutes. That's what you're trying to aim for. So you're using that built-in little 70% advantage. It doesn't mean it's going to go to mid gap today. It doesn't mean that it won't go higher. It could take the high out. Here comes a stop. Almost got it. Come on. Come on. Conditions. So we went back up and touched the bottom of that fair value gap here. And again, we're on a 15-second chart. So sell side now has moved down to here. And we're focusing primarily on the return back into discounts. So that's going to be this upper quadrant level. This blue line here is the upper 75% level of the highest high to the next quadrant measurement of the total opening range gap. And that's below. So below this low here, if we drop down to tack this sell side liquidity pool, it could trade down below that into the upper quadrant level is what I'm saying. I'm looking at these relative equal highs here, and then we went back in here to the first fair value gap. So we're watching the high end top of that initial fair value gap over here on the 1 minute chart, upper left hand chart. So we're back inside there. It can spike up and re-deliver to the high of it. I just want to see the body stay at the middle point or below. And if we can manage to do that and then roll outside of it once more, then I think what we'll do is just make an attempt to get down into this inefficiency and attack the sell side here. Otherwise, I'm not interested in going long. So if it rallies, it'll do it without me. So we had a little mohawk here. There's a little portion of this area up here it could be trading up into. And we'll just take the middle level into account. So from this candlestick's high, this candlestick's low, midpoint, that's consequent encroachment. You can see that's traded there, and then look at the reaction off that. That's nice. And the bodies did not lay on top of that mid gap. So look at this low here. That's a minor, and this is a minor sell side. So keeping in mind, this is the range for 20 handles. Do we see ranges that afford us working from anywhere in here, upper quadrant, mid, lower quadrant, or the low of the inversion fair value gap? Can that yield the potential of moving at least this much? So both of these are sell side, but they're minor, but they can still yield. So now I like to see that. I don't want to see it close up and get close to this. I want to see this candlestick close down and create. See, it's closed right back in. I can't use that one now. So now we left the inversion fair value gap. We left it. We had one candlestick come back and touch it. So any displacement lower that creates a fair value gap, I'll use that on the 15-second chart to enter. All right, now see what it's done? Think about what I've just outlined, Caleb. We wanted to see this displacement below this fair value, the fair value gap. Easy for you to say, ICT. The first fair value gap of the morning. And I wanted to see it trade below it and show displacement. If this candlestick would have not had this high come back and touch this candlestick's low, that would have been a fair value gap. And then I could have used that one, and I would have traded to get down to here. But because it went and touched it, then I have to wait for now another displacement lower where it creates a fair value gap. Okay, so we came all the way back up into this gap here. I'm going to make this ugly color because I want it to stand out so you can see. So we bumped this little short-term high here. So we bumped the old high here. So this was the initial high today. There. If we take out this high here, we might be seeing a larger run higher. Admittedly, on the daily chart, that is in the cards, but I still wanted to see it offer another opportunity to get towards that mid gap. It doesn't need to fill it today because everything technically is really bullish. So the buy side is not here anymore. It's here. All right, so this is 2 times. We made a higher high intraday with a huge opening range gap. We've already worked the initial first presented fair value gap here. We dropped down in here, and we didn't get the setup that I was wanting to see here. So this was a raid, and this was another crest into a higher high. So we have to hold on to this area right here. Watch what I'm about to show you. This is liquidity, okay? This is another lesson that you ain't going to see in anybody else's bullshit. This was your initial high. This was the stop run that took out that initial high. All of this shaded area that I highlighted, now that area, you treat that as a balanced price range. Extend that over. We don't need this gap here. Take that off. So now what do we do with this information? You have sell side here. You have a pool of sell side here. You have sell side there. First presented fair value gap down here. This is a balanced price range because it took a run into real orders. This was not contrived. It's not some just random area. This was exactly where buy orders were brought into the marketplace and smart money sold to those individuals to drive them into loss. Because when the retail traders use this area here to go long on a breakout above the initial high of the day here, they're trapped long. So the market's going to gravitate to opposing liquidity. Where's that? Sell side. Where's that? Right below that low. How far can we reasonably expect it to go below this low, Michael? Your handy dandy Fibonacci. Place it on your high. That's your highest candle in all of this swing high. It's anchored to the highest high. Drop it down to the low here. This is the first measurement I gave you. Whenever you have a dealing range and you want to look for external liquidity, measure the range, which is this high here, down to that low. Your first stepping stone to understanding how far prices can go beyond that or outside the range is negative 0.25. That's this level here. Did it trade there? Yes. But if it's going to do a measured run, it's simply just a negative 1 standard deviation. That's down here. That gets us to that upper quadrant level. In the fib, you graduate from a negative 0.25 level to what's half of the negative 1? It's negative 0.5. Look where the bodies are. When I'm looking at this price leg here, I'm getting an approximation because it's just simply like I'm teaching you, Caleb, to look at these 20 handle runs in measurement and size and getting familiar with what that looks like. This run here to here, half of that run was when we were down here, when it was trading at $75 to $100 open unrealized profit. That's why I'm saying close that. If you were in a day that didn't have this multiple 100 handle opening gap, you could take this as a partial and then aim for the upper quadrant level of the opening range gap. That's what this level is here. And then if it's going to go down below that, which is likely, what would it reach for? 1 standard deviation or a measured move of this high to that low projected below this low takes us down to here. But because we have a huge gap, chances are it can do what? Continuation. But initially, while you're in the opening range of the day, not the opening range gap, the opening range, which is 9:30 in the morning Eastern time to 10 o'clock, after a very large opening range gap higher, always expect them to drop it down, create an initial high of the day, and then run that. And then there's a deeper retracement into it. Whether it gets to the mid gap, upper quadrant level, doesn't matter. It frames the logic where you can take a very easy bread and butter setup, which is what I outlined. All of this here was that. But when you look at this initial high, it's unreasonable based on what I taught you today and what I taught in core content lessons too and mentorship. It's unreasonable to anticipate the market to come right back up to that high and stop as resistance. But it is reasonable based on algorithmic principles that it will go above that high to get the orders for the express purposes of going lower to attack them. So they're targeting retail mindset. So here's the thing. This high here, it's not going to be resistance. It's going to be absorbing buy stops above that. So when it does this very thing here, this creates this whole pocket. It becomes a balanced price range. That means that this high will absolutely be just like a support and resistance book will tell you, okay, here's resistance, broken, turn support. Where are you going to look for that setup to form? That's an array. That's a data point. Just like a program's going to go and, okay, I need to do this calculation, I need to get the source information. So that data, where is it? Well, it's in that first 30 minutes of trading. What is the first data point? Where we first open up at. The first 9:30 print in relationship to where we settled previous day. So you have two arrays of information right there. Are we above or below at the opening at 9:30? If we're above, okay, what's the midpoint between those 2 price points? Yesterday's settlement price at 414 and 9:30 opening price today. If we're opening higher at 9:30 today, that means that the draw, initial draw or the bias for you is going to be lower. And you are submitting to the idea that it doesn't need to get to that midpoint gap. It doesn't need the price there yet. But that's your bias. And then you're waiting until 931's candlestick closes. And then at 932, if 931 creates a fair value gap, that's your first fair value gap of the day. That is your focus point for the range that your setup is going to form at or near. Time and price theory. My time and price theory is fucking macros. That means 20-minute intervals every single hour of every single day. The last 10 minutes before the top of the hour and the first 10 minutes of the top of the hour. Every single hour. That's my time and price theory.